name is Oliver Preisendorfer. I'm heading the sales in the Dachau region of Infront. This covers, of course, our whole product offering. But today we will focus on one of my favorite topics, which is bond valuation services as part of our feed services that we provide. So quickly, as you see on the right-hand side, we are talking about valuation, evaluated pricing, and quants. We have the typical quant on the right-hand side. Hopefully looks a bit like us, at least for Carsten, maybe. I forgot my glasses today. So the agenda, welcome and introduction. So we will speak also a little bit about Infront upfront, and then deep dive into the topic and the market nets and the relevance of the model-based valuations that we have, and how transparency helps us and our clients to succeed in this regard, and what are the values that can be helpful additionally. And then we have a Q&A, and I strongly recommend to just pose in questions into the chat if you like. Feel free to put those in. We answer that by the end of the session in the Q&A part of it. And then we have a slightly small outlook on what's to come from Infront in the regard of valuations and bond pricing. So let's go to the next slide. Some numbers really quick about Infront. So we are a typical data provider, which also sells a lot of software in regards of portfolio management, trading technology, but especially in valuation services. And as you can see, 3,600 customers, 90K professional users within banks, brokers, exchanges, asset managers, custodians, and so on. We are 500 employees. Worth mentioning is that we are over the half of it is developers, so that makes us pretty much quick to react to client needs when it comes to software and also feeds that we structure, and of course the evaluated pricing that we are speaking of today. But we are not too large to move like a slow-moving tanker like other companies, so that makes it pretty attractive for our clients. And worth mentioning also the 8 billion data points that we process daily. This is pure contribution exchange data, as well as additionally data that we source directly. And on top come our internal calculations and valuations. We do that for 30 million of instruments plus. And this is only the liquid part of the portfolio that we cover. Of course, we do have structured products, OTC derivatives, whatever you can think of, that we also do valuation for. Let's go to the next slide. So what is our total offering before we really dig down on the bond pricing today? First to mention in regards to bond pricing, of course, the feeds that we do have, different kind of feeds, state-of-the-art technology, different APIs that you can use for whatever purpose is it, being it for the back end, for your back end system, being it for your portfolio management system, or the front end display on websites, whatever you like to do with it. And of course, the valuation and risk part adds to this. We have a lot of clients that are using also additionally, as I just mentioned, the OTC part and the structured product part, where it comes down to everything exotic that you can think of, where they use our prices for. Of course, we offer data in a terminal, just as you know, from all the other vendors. It's just to visualize the stuff and also have some calculators in there that help you in your daily work. And then we have the trading technology, which we won't touch upon too much today, as well as the portfolio management solution, as we are the leader in portfolio management services in Germany, for example. And the advisory part, which goes, of course, into the portfolio management system when you onboard a client and trying to advise them. But let's move forward. Market need. I think this is interesting for you. We are now starting to give a little overview over the market, the bond market, and then drill it down to probably and hopefully your needs of the data. So you see the global bond market size is 142 trillion, which is of course huge. Then you have the region split below. But even more interesting is that the market size grew by 300% in just 20 years. So this is an important asset class, especially for North America, Europe, and Asia as well. But nonetheless, the trading volume is quite low. It's just 1 trillion out of 142. So you see how illiquid the market is, because people tend, of course, to buy and hold a little bit more. It's a quite secure market, and you can still make a lot of money out of the interest rates and so on. And if you look at the obstacles that come with those low trading experience, is that the liquidity is low. And as you see, for example, the US corporate bonds, they only have a bid-ask spread of 0.5%. You can say only, but I think it's quite large, as because when you have a high investment in there, a lot of money pumped up in your bonds, then it might be hard, just 1.0% margin here. So you need to really be on top of your game, knowing exactly how to price your bond, where it really stands, and avoid market trends or recognize market trends early. So as you can see, the illiquid bonds, they have already a bid-ask spread of 2% or even more. So you see how important the valuation and knowing your product is. And the turnover ratio, of course, is below 10%. And that leads over also to the market depths, because just a smaller trade can significantly have an effect on your price of your bond, because only the liquid ones can absorb larger trades with a smaller price impact, of course. So, and then we are covering the use cases, and this we try to cover, looking at the list of registrants today, all your needs that you probably touch upon in your daily business, because we have people from different parts of the business joining. First off, it's private wealth. If you're an independent advisor or even more family office, and you have a large investment in illiquid bonds or in structured products, OTC derivatives, then of course you want to know your risk in your portfolio, and you want to have the daily transparency for your family that you cater to. So it's worth it to look into and to be on top of your game, knowing the transparent pricing. And it is probably even more for the institutional asset manager, because that's where they make their money, that's where they make their business, right? So a coherent coverage and transparently pricing of the bonds is key. And here, additionally, for them, also, of course, the auditors and the regulatory part is important to cover that. So you need to be sure that you can explain every price that you use. We are very transparent on our pricing. We are having the models transparent. We are having the input parameters transparent. And we also do automated reporting on those pricings daily, if you want to have that. Custodians, yeah, it's the other way around, right? They are controlling the prices that they get from the asset managers. Of course, we do high and low calculations for that as well, so you can do the spread check if the price is in the correct range or not. For banks, it's a little bit different, because in the liquid bond market that they are probably invested or trade in, they need to ensure market conformity to not be ripped off by way of prices from their counterparty. That's why they, of course, want to see what the real market price is, and not the ones that they get offered probably. Treasury, so welcome all corporates today as well, for risk and credit, FX risk, and for liquidity management is definitely key, and for your reporting standard to be on top of the bond pricing as well. We have quite a substantial number of treasurers and corporates already as our customers, not only supplying evaluated pricings for bonds, but as well we do offer an extensive amount of data for credit, FX, CLOs, CDS, and whatever you can think of. And broker trading, last but not least, we have some Nordic people joining today from Nordic banks. So if you want to know the exact cost of your trade up front, it's of course key you know the price of your instrument that you want to trade. Well, that's why the calculated bond price is also key for the trading purposes as well. And again, please feel free to just post questions in. Do not hesitate. Please do so. It makes it more lively and interactive for us here.
Maybe I kick in and just to add to the numbers you already mentioned here. So it's just around 1% of the issued bonds which are really traded regularly, but you need prices for the remaining 99% as well. And I think it was one of the recent annual reports of the European Banking Authority from the EBA, which clearly showed that the illiquid level 3 fair value assets have the biggest growing share within the bonds. And you also have some non-functional requirements there as well. Oli already touched that. To a certain extent, you have, as an example, IFRS 13, MiFID II, and in Germany we have the KAR BV, which all require a robust, transparent, comprehensive, reliable, and continuous valuation. And yeah, you need to explain every valuation to your auditor, to your counterparties, historically, etc. And it needs to be audit-proof. So that might be difficult for Excel-based calculations and internal estimations as well. You also need to have consistency. So that means all assumptions, data, and the models being used within a portfolio should be more or less the same, or at least consistent. And then you need to be somehow automated in order not to have a manual process, but rather something which helps you to digitize your whole organization. And yeah, that's the non-functional requirements. But at the end, accuracy and transparency is key. So yes, what we believe can help you to get a better understanding or a better transparency for your fixed income. So let's take a look at how the liquidity of the bond influences its valuation. So for this purpose, we have introduced the Infront bond score. And this score ranges from 10, representing the most liquid bonds, all the way down to 1, which indicates complete illiquidity. Accordingly, the methods used to determine the price differ significantly depending on where a bond falls within the scale. So let's begin with the score range 10 to 7. That's the highly liquid segment. And bonds in this category are actively traded on the market. This typically includes standard fixed or floating rate bonds that are listed and traded regularly on exchanges, but also OTC. And for these bonds, pricing is based directly on market data. By incorporating prices from all available trading venues, brokers, contributors, ideally using volume-weighted averages to avoid distortions caused by small trades. And typical issuers include governments, regional authorities, large banks, industrial corporations, and mainly in Europe and the US. Well, yeah, essentially well-established names with transparent, active secondary markets. The valuation models in this segment are usually straightforward. Often just a weighted average of market price is sufficient, since the market provides reliable and observable information. Now let's turn to the score 1 to 6 range. That represents the low to very low liquidity. And bonds in this segment fall into 3 main groups. The first, we have the standard fixed or floating bonds that are not exchange traded. So in example, promissory notes, or in Germany it would be the Schuldscheindarlehen. Then second, we have the structured bonds, such as multi-callables, fixed to floats, partial redemptions, etc. And then third, we have exotic bonds, such as inflation-linked bonds, dual currency bonds, or range accruals, just to name a few of them. And because these instruments lack regular market activity, reliable market pricing is often not available. Instead, model pricing is required, drawing on market observable inputs, such as issuer or sector curves or reference bonds from the same issuers. Typical issuers in this segment might include subordinated debt from banks or corporates, emerging markets, or special purpose vehicles. The valuation models are more complex here. So when discounting the expected future cash flows for bonds with simple embedded options like early redemption and therefore a given uncertainty, models such as the Bachelier model are applied. For more complex instruments, which is what is then one of our expertise, such as multi-callable bonds or CMS-linked structures, we employ stochastic interest rate models, such as the Hull-White model with Monte Carlo simulations. And yeah, maybe I give you a little bit more background. So when you're dealing with bonds that have embedded options like callable corporate bonds or mortgage-backed securities, a simple present value model often isn't enough. That's where then the so-called option-adjusted spread model comes in, or OAS for short. And the OAS model simulates thousands of possible future interest rate paths, and in each of these scenarios, it checks whether the issuer would choose to call the bond early, because that direction, of course, directly affects the expected cash flow. Then the scenario-based cash flows are then discounted using a constant spread over the risk-free curve. And the OAS is then exactly the spread that explains the observed market price by accounting for the option. And that's computationally very intensive, but also extremely powerful. And it's also the only way to properly value and compare and report on complex bonds in a portfolio. So to summarize, the more liquid a bond is, the closer its valuation can be to a true market price, and often derived directly from actual trades. The less liquid and more complex the structure, the more we must rely on model-driven pricing with increasing degrees of abstraction. So the liquidity score is not just a measure of tradability, it also plays a central role in determining how we price a bond in practice. And you might have noticed in the screenshot, which has been taken from our internal bonds lookup service, this market implied rating. And you're wondering what that is. Well, this is maybe even a more valuable input for you. So credit rating agencies regularly assess the issuers, either on scheduled basis or when specific events occur. However, in many cases, the market reacts way earlier than the rating agency. So news and developments often reach the investors first, and the market quickly prices in these new information and adjusts the yield of an issuer bonds accordingly. And the rating agencies like Moody's typically respond with a time lag and only later update their official rating. Our service continuously monitors the bonds of each issuer and it identifies when their pricing behavior shifts significantly towards the yield curve of a different rating category, and even before the official rating is announced. You can see here, we see the old rating, the A- rating with a blue curve, and the new curve with the BBB plus in orange. So the market is pricing the VW bonds already with a wider spread, consistent with a lower rating, already in January, so 2nd of January, even though the eventual rating change from Moody's was relatively small. And it's also noticeably that all VW bonds are now aligning with a different yield curve, showing how the market had anticipated the move then well in advance, because Moody announced their rating change mid of March. So how do we deliver the information to you? So we have more or less 3 different ways to do that. First of all, of course, we deliver this with our standard feed to you, which can be also customized to your needs, meaning that it fits well for your fund accounting system, for your risk management or portfolio management system. And it can also include, apart from the valuation price, also the IQ bond score, the yield to maturity, the Z spread, also the G spread or the I spread. We can also include the asset swap spread and the market implied rating, which I've shown to you. It can also be delivered via a data manager regulatory feed to you. This is a solution where we have already some very satisfied customers using the services and the valuation prices. That service covers also the liquid parts of equities, exchange traded derivatives as well, and delivers a valuation price for each and every position in your portfolio every single day, and provides also a transparency report for you so that you know why a price has been chosen or evaluated. And then last but not least, we have, of course, on-demand requests whenever you have very exotic, very bespoke trades or investments in alternatives or real estate. And of course, we also can evaluate them and provide you with a report, not only regarding the valuation results, but also the models being used, the assumptions, and also very important, the direct contact to the specialist who did the calculation. So whenever there is a question, you have direct access to the experts who can help you to understand and also to translate this to counterparties or other parties. To sum it up, deliver you the valuation prices, the IQ, bond scores, and the figures, and all of that with the highest accuracy, of course, just because we're using very accurate data and have also a very accurate data cleansing process, and also with a high transparency. So we only use self-developed modules for that, no black box, so we can explain each and every single step, each and every value which leads to the result. And all the models are based on recognized scientific methodologies, so it's nothing completely uncommon, but also optimized, and then, as said, with the premium support, so that you have the best possible support whenever you need help with a certain valuation or with a with a new product you plan to invest in. And the best of it all, you just pay only what you need and nothing more. So we come with really matching packages for you and not large packages where you only need a fraction of it. All right, I think then it's time for some questions.
We have one question. So the question was, what data do you use, and do you have quality assurance measures?
Oh, yeah. Sure. Well, definitely we're using market data from exchanges for sure, but also from contributors, from brokers, from platforms, and we extend this data offering all the time. We just recently closed a new contract with a prime broker in the Nordics. So in order to even more improve our market data coverage there, to have even better visibility in that market. And of course, we are cleansing the data or quality assurances there in order to have nice curves and not very bumpy ones. So that exceptions are cleaned out before being used for the models.
Then the second question is, do you offer transparent audit trails for the evaluated data?
Absolutely. So our processes have a very comprehensive audit trail and audit logging. So therefore, we are able to deliver the audit reports for our customers also later on, but also on demand. And within our data management regulatory suite, we deliver audit trails in level 1, level 2 versions, so that expresses the comprehensiveness on a daily basis. There's also a question, what does premium support mean? The premium support means that you have direct access to the experts who do the valuation. So whenever you have a question, we typically respond within 1 or 2 hours with the right answer, not only with the ticket number to you, so that you can be sure to finish your daily work very quickly with us. And I think this is also a USP our existing customers really like us for.
How can we test your valuation services? Maybe I can elaborate on that, as it will be in the next slides as well. So this is the call to action, maybe a little bit earlier than expected. So whenever you would like to test something, just give us a portfolio that you would like to test, to stress test probably. It can be an ISIN-based one, but you can also send us some term sheets or whatever you have on your OTC structured products, and we do some example pricing so that you can compare it to what you have and see the transparency as well as the exactness of it. And do you have historical data? Is another question. Yes, we do. So we cover up to 30 years backwards of historical data. That means, of course, end of day historical data. For tick by tick data, we do also cover 10 years. So that is especially of interest for the arrival price calculations, for example, when we do get the tick by tick data, and also for the market conformity, where we also arrange around the trade time to do the market conformity checks. So yes, we do cover a lot of historical data.
Right.
And then another question, how is your service different to ICE CEP or Bloomberg's BVAL? And how many evaluators are involved in the daily evaluations?
Well, just to pick up on that, so our service provides, from our perspective, a way better transparency. So you get all the data which went into the building of the scores, the methodology behind. I know at least to a certain extent what the methodology behind one of these alternative services are, and I can at least say that we provide more transparency, but also more support. And it can also always happen that you have a very strong opinion on how to price something, and or you are forced to do some assumptions which we don't have per default, but we are then super flexible to adjust this and provide you with a dedicated delivery instead of just staying with one solution we have there by default. I see that there are some other questions coming in. I think we collect them and provide them later on as an FAQ. And therefore, if you don't mind, maybe we just give a quick outlook also what's coming next. So we've been performing complex valuations since decades and are proud to have a large base of highly satisfied clients. And we're now taking the next step and productize many of these services we've already developed and integrate them into our standard product offerings. And one exciting example is our bond pricing terminal, where I just took a screenshot earlier on. It's being used internally as of today, but we are making it available as part of our standard terminal solutions. And it provides far more data and functionality than I could possibly cover in this session. So maybe this will be then a separate webinar. And we're also preparing to launch our IQ risk platform, and that builds on many of the risk metrics we have discussed today, but it goes much further. And this platform supports comprehensive risk management, whether you're focused on individual instruments or portfolios or portfolio groups. And so you'll be able to explore various risk scenarios, analyze the risk or profit and loss contribution of each position. And you can even simulate portfolio shifts to assess their impact on your overall risk exposure.
How can you reach us? How can you test the service? Let's put it like that. Of course, we can have a deep dive session with us too, or our Quante colleagues on dedicated topics. Feel free to reach out. Same for the coverage check. We can discuss whole portfolios. We do cover, of course, different clients with 1,000 of instruments until also smaller parts like 2 to 10 or whatever. Send us the most vicious ones that you have and do a test evaluation with us so we can prove how transparent and exact we are. And then, of course, we can also give a price tag based on your portfolio. In general, maybe to say that we are transparent as well in our pricing. You only pay for what you need, not for some data packages or whatever. You pay for the exact amount of instruments that you retrieve on a monthly basis. And we, of course, divide a little bit into different kind of categories of how hard they are to evaluate. And that's the pricing based on. So really looking forward to your input. Thank you for listening to the webinar. hopefully you find it attractive, and yeah, looking forward to hear from you and evaluate some prices for you.
Yeah, thanks for joining, and yeah, looking forward to hear from you.
Thank you. Have a good day. Take care.